Anita, you are not going to believe the post I saw this morning. Some guy on X was saying AI is already beating professional investors, even Warren Buffett, at picking stocks. And not just by a little. He made it sound like humans are officially done.
That's quite a claim, Joe. AI replacing one of the most successful investors in history? That's not a small debate. Hi, everyone. Welcome back to the channel. If you're new here, I'm Anita. And today we're diving into a fascinating question. Can AI really outperform Warren Buffett?
Honestly, it sounds crazy. Buffett has decades of experience, a net worth over $100 billion, and a track record that's basically legendary. How could a computer program possibly compete with that?
Well, it's not just about competing. It's about comparing two completely different approaches to investing. On one side, we have Buffett, the master of long-term value investing, buying solid companies and holding them for years, sometimes decades. On the other, AI, capable of processing mountains of data in seconds, analyzing patterns across thousands of assets, and making trades without a shred of emotion.
So basically, we're putting the ultimate human investor against the ultimate machine investor.
Exactly. And if you think about it, it's almost like a boxing match. Experience and intuition in one corner, speed and raw processing power in the other. But here's the real question for you watching at home. If you had to trust your money to one, which would you pick? Let's break it down. Let's start with Warren Buffett's strategy. Buffett is famous for something called value investing. That means he looks for companies that are undervalued compared to what they're really worth. He's not chasing hype or the latest trend. He's looking for solid businesses with strong fundamentals.
Fundamentals meaning, what exactly?
Things like steady earnings, good management, a competitive advantage, and a product or service that people actually need. Buffett's golden rule is to only invest in businesses he understands. If it's too complex or outside his circle of competence, he walks away.
So no jumping on the next meme coin.
Exactly. And here's the thing. He's incredibly patient. Take Coca-Cola, for example. Buffett started buying shares back in the late 1980s. That stake, which cost him about 1.3 billion at the time, is now worth over 25 billion and pays him more than 700 million a year in dividends alone. He's been known to hold a stock for 10, 20, even 30 years. He's not in a rush. He treats stocks like owning part of a business, not lottery tickets.
That's kind of the opposite of how most people invest today.
It is. And that's part of the lesson. The market rewards patience more than emotion. If you're watching this right now and want to build wealth over time, study Buffett's discipline. And while you're here, hit that subscribe button and let us know in the comments. Do you think patience still works in today's fast-paced market? I'd love to hear your thoughts.
Okay, that makes sense. But I have to ask, if patience is so powerful, why are people saying AI might be better?
That's where things get interesting. Let's talk about what AI can do that even Warren Buffett can't. First, speed. Buffett is brilliant, but he's still human. It might take him weeks to dig through annual reports, analyze a company's financials, and decide if it's worth buying. AI can do that level of analysis across thousands of companies in seconds.
Seconds? That's insane.
Exactly. Imagine a system that's scanning the entire global market 24/7, pulling data from financial statements, news headlines, social media sentiment, and even satellite images of store parking lots. All at the same time, no human alive can process that much information that quickly.
Okay, but being fast doesn't always mean being right.
True, but here's another edge. No emotions. Humans panic when prices drop and get greedy when they rise. Even the best investors battle fear and FOMO. AI doesn't care. It doesn't sell because of bad headlines or buy because of hype. It follows the data.
So no fear, no greed?
Exactly. And here's where it gets powerful. AI can run backtests on decades of market data in minutes. It can simulate thousands of what if scenarios. What if inflation spikes? What if a major tech company misses earnings? What if oil prices crash? Then it instantly adjusts its strategy. In one simulation using real market data, an AI-driven portfolio starting with $1 million grew to $1.32 million in 12 months. A traditional diversified human-managed portfolio in the same time frame only hit about $1.18 million.
That's a big gap for just 1 year.
And that's the point. In a 1 year head-to-head, AI's adaptability often wins. Buffett's style is like buying a great company and watching it grow over decades. AI's style is like finding dozens of great short-term opportunities and taking advantage of them before anyone else even notices.
So Buffett might turn $1 million into $2 million over 8 to 10 years, while AI could pull off a huge gain in just 1 or 2.
Exactly. Short-term, AI can rack up returns at a pace humans simply can't match. But long-term, that's where the contest gets more interesting.
So short term, AI's looking unbeatable. But there's got to be a catch, right?
Absolutely. Let's start with Buffett's limitation: speed and adaptability. He can't scan every market in real time, so he sometimes misses quick gains. But AI has its own weaknesses. It doesn't truly understand human behavior, brand loyalty, or cultural shifts. It only sees the data, and if that data is wrong or incomplete, it can make bad decisions. Fast.
Give me an example.
Sure. In 2021, an AI model misread short-term retail data during the holiday season and dumped a stock just before it rallied 35% in 2 weeks. A human investor who understood the seasonal patterns would have held on. On the flip side, think of Buffett holding Coca-Cola for decades. That patience turned a $1.3 billion investment into over $25 billion. But while that's incredible over 30 years, an AI model might have doubled that initial investment in a fraction of the time, then reinvested those profits into other opportunities.
So it's kind of like a sports car versus a freight train.
Exactly. The sports car, AI, can sprint ahead and make quick gains. The freight train, Buffett, moves slower but keeps going through market storms without derailing. If you started with $10,000 and invested like Buffett, you might turn it into $40,000 over 15 years. With AI, you might grow it to $18,000 in just 1 year. But you'd need to manage the higher risk of sudden drops.
So the smartest move might be a mix of both.
That's my take. Let AI do the heavy lifting, finding opportunities, scanning the markets, crunching the numbers. Then apply human judgment to decide which ones are worth holding for the long haul. It's a hybrid approach that can give you speed and safety.
Sounds like the best of both worlds.
Exactly. And if you're watching this, ask yourself, are you more like Buffett, patient and long term, or are you ready to use AI to chase faster gains? Drop your answer in the comments and don't forget to subscribe. In our next videos, we'll break down real portfolios, test AI strategies live, and see just how far we can push that initial investment, whether it's $1,000, $10,000, or $1 million.